Welcome to Macro Decoded, your channel for unmasking the economic and geopolitical forces shaping our world. Today, we uncover a story that is changing the technology landscape and raising profound questions about the future. The mind-boggling $500 billion AI infrastructure spending spree by tech giants like Microsoft, Amazon, Meta, and Alphabet. This wave of investment is transforming global markets, fueling debates about economic growth, and pushing the boundaries of what machines and societies can achieve. It's the kind of story that merges ambition, risk, and innovation at a scale rarely seen outside of wartime mobilizations or revolutionary technological shifts. But is this just the start of a golden age for artificial intelligence? Or are we witnessing the inflation of the next big tech bubble, one that might burst with far-reaching consequences? If you're fascinated by the forces driving our future, hit that subscribe button and join Macro Decoded for more in-depth insights every week. Let's set the scene. Just last quarter, Microsoft, Amazon, Meta, and Alphabet together announced capital expenditures that will total around $370 billion in 2025, an astronomical figure, with projections already suggesting this number will climb well beyond $400 billion in 2026. Microsoft alone spent almost $35 billion just on data centers and related investments, which is nearly half of its revenue. In fact, this level of spending is so massive, economists believe it constituted nearly the entirety of US GDP growth in the first half of 2025. Imagine a single industry powering the economic engine of one of the world's largest economies. But what's behind these huge numbers? Where's this money going, and who stands to benefit or lose out in this AI gold rush? The bulk of these investments are pouring into a technological arms race unlike anything we've seen before. Nearly 90% of this capital is flowing straight to the cloud. Massive warehouses packed with servers, most of them powered by Nvidia's high-performance GPUs, which are now so critical that hyperscalers scramble to secure them in bulk years in advance. In the second quarter of 2025 alone, organizations spent more than $82 billion on AI infrastructure, more than double the previous year. Of that, over 90% was for servers turbocharged with GPU or XPU accelerators, highlighting an existential shift from traditional IT to AI-optimized hardware. That's not all. A peer Oracle and partners signed $1 trillion in infrastructure commitments through 2035, including the eye-popping Stargate project, a $500 billion bet on AGI-ready supercomputing. These numbers are almost too big to grasp. So, what are we really building? The answer? Entire new digital cities, humming day and night with the computations of artificial intelligence. These AI data centers consume as much electricity as small countries, drawing billions of gallons of water each year for cooling systems. The world's hottest chips, Nvidia's H100s, now being replaced by Blackwell, and next-generation 2nm and 1.6nm silicon are being stamped out in Taiwan and increasingly in US facilities funded with tens of billions in incentives. This is no digital mirage. It's a concrete, physical transformation of our energy grid, supply chains, and physical infrastructure. Yet, the stakes and costs extend far beyond hardware. As AI infrastructure expands, so does the race between the US and China for global dominance. In November 2025, the US government banned the latest Blackwell chips from being sold to Chinese firms, hardening the technological Iron Curtain. The world's AI prowess now hangs on the supply chains of TSMC in Taiwan, a geopolitical flashpoint and a manufacturing bottleneck. If anything disrupts those supply lines, the consequences could ripple through every industry on Earth. On the ground, this boom is both a lifeline and a ticking clock. It's driving local electricity and water consumption through the roof, sometimes creating friction with communities that live near new hyperscale data centers. Now, let's talk about who's winning. Nvidia has clinched 85 to 90% of the AI chip market, with data center revenues far outpacing competitors. Hyperscalers are pouring cash into acquiring more GPUs and leasing every megawatt they can find. Construction jobs are booming as new data centers break ground across North America, Europe, and Asia. Demand for data center technicians, electricians, and network engineers is rising, with some wages up 40% in just 3 years. But here comes the paradox. Once the buildings are up, each data center employs only a handful of full-time staff. We are building huge complexes with very few long-term jobs, a dynamic that's reshaping both regional economies and global expectations about work. And this brings up a hard question. Are we chasing real returns or just numbers on a spreadsheet? Emerging research claims that organizations are already seeing big gains. Some report a return of $1.36 for every $1 invested in AI, and more than 2/3 of surveyed companies expect significant productivity improvements within a year. Enterprises are embracing AI for everything from customer service to logistics, hoping to replicate these results at scale. Yet, only 5% of generative AI pilots produce results that persist across the business. Many businesses are finding that beyond the glittering top-line savings, the actual value can be elusive, requiring more than just cash. It takes strategy, skilled people, and time. Meanwhile, the stock market is on fire. Since late 2022, tech stocks tied to AI infrastructure have driven more than 75% of S&P 500 returns and created enormous windfalls for investors. Nvidia, Microsoft, Google, and Meta are the big winners, at least for now. But dark clouds are forming. Industry leaders themselves, from Sam Altman and Jeff Bezos to Mark Zuckerberg and David Solomon, are warning that we could be living through a new tech bubble. Altman himself said, "People will overinvest and lose money." Bank of England, IMF, and leading Wall Street CEOs are expressing open concern that the excesses resemble the dot-com boom. And we all know how that ended. And here's where things get especially interesting. History tells us that transformative technologies often require overinvestment. In the early 2000s, we overbuilt fiber optic networks, but that surplus infrastructure became the backbone of the internet economy. Maybe the world's AI supercomputers will one day do the same, accelerating innovation so dramatically that the investment seems obvious in hindsight. Or, just maybe, the combination of capital overreach, rising construction and energy costs, and unproven business models will lead to an epic market correction. Either way, the stakes are immense for technologists, investors, policymakers, and society at large. So, what's next? AI now touches everything, from electricity grids and real estate markets to geopolitics and the very nature of work. The world's corporate and government leaders are betting that this spending spree is the cornerstone of a new economic era. But history also reminds us to keep a skeptical eye on runaway hype, to ask, are these investments pulling us toward genuine productivity and shared prosperity? Or are we simply building castles on quicksand? Thanks for joining Macro Decoded as we unpacked the biggest AI infrastructure boom in human history. If this story gave you a new perspective on the forces shaping tomorrow, give us a thumbs up and hit that subscribe button. See you in the next episode.